According to the Office of National Statistics, as of 2021, approximately 22.6 million people were enrolled in workplace pension schemes. Now, this is in part due to the huge success of auto-enrollment since 2012, which has meant that a further 10.7 million people have started to save consistently for their future. Now, this means that a total of 79% of the eligible workforce are now thankfully saving for their retirement. And in 2022, a total of £116 billion was contributed into pensions across the UK in that tax year, reinforcing the importance of taking greater control of your retirement planning. Now, the ugly truth is that an estimated 95% of employees are invested in the scheme pension default fund, which is designed to be a one-size-fits-all approach. But how can a 22-year-old have the same investment approach as a 60-year-old? It just doesn't make sense. Now, a workplace pension scheme must offer a default fund to receive both the employee and the employer contributions. But the ugly truth is that this is likely to mean that you're going to be invested in a lifestyle fund, which could leave you worse off in retirement, but more of that later. Now, another ugly truth is that there is even a need for a default fund in the first place, as these have been designed for those who've got either little time or little experience to select an alternative fund. Now, they are described as being broadly suitable for most people. Now, what problems can you foresee with that description? And you can leave your comments in the section below. Now, another ugly truth is that for younger employees who are just starting out on their career, on the current level of pension contributions, they are expected to retire on just 53% of what would be required to pay for a comfortable standard of living in retirement. So in this week's video, I'm going to be discussing workplace pensions, and by not taking control of your investment approach, you could be sleepwalking into a poorer retirement and a lower standard of living. So welcome back to the channel, and if this is your first time, a very warm welcome to the Economies channel, where together we're going to be learning the language of money and wealth. And on this channel, we're dedicated to mastering money and making financial wisdom available to all. Now, before we get into this important topic, I'm going to pop up the usual disclaimer to state that this video is for education and entertainment purposes only and shouldn't be misconstrued or misunderstood as offering financial advice. Now, before we start, I just wanted to say a big thank you to Tony, who correctly identified one of our modern day philosophers called Tyler Durden, who went on to say, "We buy things that we don't need with money that we don't have to impress people who don't care." And this was, of course, the character played by Brad Pitt in Fight Club. We loved your sense of humour, Tony, and thank you for getting involved. Now, in this video, we're going to explore the multifaceted nature of workplace pensions, covering their historical development, some investment strategies, such as the default lifestyle funds, some behavioural finance and emotions that we need to control, as well as some of the significant changes introduced by pensions freedoms in 2015. Now, workplace pensions were often seen by an employer as an expensive additional benefit and seen by the employee as a contribution that they could ill afford. Now, the pension landscape had evolved away from the generous and the secure income provided by a defined benefit scheme. This is where the income for the employee at age 65 was known, but the cost of providing that benefit was unknown, and that has continued to rise with all the investment risk being borne by the employer. This then favoured defined contribution schemes where the opposite was true. Now, this is where the level of contribution was known, but the final income level at age 65 was unknown, and this would depend on investment performance, and this investment risk was borne by the employee. Now, auto-enrollment was introduced in October 2012 for the largest companies in the UK. And even the smallest companies needed to adopt this new legislation by 2018. And this was a significant shift in how pensions were managed in the UK. This initiative was due to the very real concerns that many workers were not saving enough for their own retirement. And by extending these pension savings to millions of other workers who are not involved in any pension scheme at all. To be automatically eligible, you needed to be between 22 years old and state retirement age and earning a minimum of £10,000 a year. Now, this enrolment could be delayed for up to 3 months, especially if you were going through a probation period or you were a seasonal worker, for example. You are then automatically enrolled, and then you could decide to opt out, but then you'd be automatically re-enrolled into the scheme every 3 years. It's worthwhile mentioning that if you do earn less than £10,000, ask your employee if you can still join the scheme. Now, the minimum contribution levels at the moment are as follows. The employer will pay 3%, you will pay 4%, and you'll receive 1% in tax relief. Now, that makes a total of 8%, but many schemes are a lot more generous than this. However, many maintain the minimum contribution levels, which is a concern for a lot of long-term savings, as this is unlikely to be enough to provide a secure retirement in the future. So make sure you ask your employer if they offer matched contributions into the pension. This is going to be considered additional free money and can have a huge difference to your fund value, especially over the long term. Now, providers of auto-enrollment schemes must offer a default fund, and this is likely to be a lifestyle fund. So what actually is a lifestyle fund? Now, these funds automatically lower the risk by adjusting the asset allocation of the pension as you get closer to retirement. This typically shifts from growth assets such as equities into more conservative assets like bonds. Now, this strategy is intended to reduce the risk of significant investment losses close to retirement by providing a more stable financial position for pensioners. The initial idea was to select a pre-retirement age, for example, of say 65, and then you'd have your pension value in cash at age 65, and then the idea was you would then take your 25% tax-free cash and use the rest to buy an annuity. But this all changed in 2015 with the pension freedoms, and it's now estimated that about 90% of people elect for drawdown instead of buying an annuity. Now you can access pensions in many different ways, such as taking various lump sums, partial tax-free cash. You can also take variable monthly income or even flexible income based on the investment dividends that the fund provides. But there's also been dramatic changes in the bond market. I mean, bonds are essentially IOUs issued by companies and by governments to raise money, and they promise to pay a fixed rate of return as well as a capital back on a set date in the future. However, bonds can be very volatile and they are very sensitive to interest rate changes, as we have seen recently as governments try to bring inflation under control. Now, this means that the value of bonds has fallen, and this has had a financial impact on lifestyle funds and for those who are close to retirement. Now, I'm going to link our annuity and our flexible access drawdown videos in the description below as well, so you can refer back to those in the future. Now, I'm going to put on screen a chart to show how a lifestyle fund might de-risk as you get closer to your retirement age. So as you can see in this chart with the blue bars, if you're about 15 years before your selected retirement age, about 100% of your fund is going to be invested in growth assets like equities. But as you can see from this chart, the dark blue bars will fall every year until around year 10. And that's when most of your money will then be invested in more moderate investments and lower risk investments. That will then continue to fall from 10 years out to just before you're due to retire, when most of your money is either going to be in cash or cash-like assets, waiting for you to make a final decision on how you want to access your final pension. I'm also going to show another chart from our friends at Vanguard from 2022. And this is going to show how sharp rises in interest rates affected bond values. So let me walk you through this chart. So as you can see on the left-hand side of this chart, this data goes back to 1990. So that's 32 years of information. And I've highlighted here 2008, which was the global financial crisis, and 2022, when bond values and equity prices both fell in conjunction. And as you can see, 2022 was the worst performing year in those 32 years of data. And as you can see on the right-hand side of the chart, with the Bloomberg Global Aggregate Bond Index, 2022 was also the worst year on record. Now, the chart on screen is from the Financial Times, and this shows the total nominal return in the US of both stocks and bonds since 1871. That's 153 years of data, and that shows that 2022 was the worst year on record. Legal & General estimated that about 700,000 people retired in 2022. So clearly having a large exposure to a so-called safer asset such as bonds caused financial distress for a lot of people in 2022. Now, some lifestyle funds will allow you to elect how you're going to access your pension fund at retirement, whether that's via an annuity or flexi access drawdown, and they'll have a suitable default fund for you to pick. But these can be rigid and they can be inflexible as well. Let's say, for example, you wanted to change your retirement age from age 62 to, let's say, age 65, or even align it with your state retirement age, which could be 66, 67, or even 68. So the ugly truth here is if you had planned to retire at age 55, for example, and then your lifestyle fund started to automatically switch into lower risk assets 10 years before, let's say, for example, at age 45, and then your circumstances changed, you could be invested in low risk assets for about a decade or longer, and that could have a significant impact on the overall fund value. It's also worth mentioning that a retirement journey could last as long as 25 years or more. So it does make sense to keep your funds invested in equities for longer to look for growth above inflation. Now, many people are going to experience procrastination as well as inertia, which is caused by having so many options to choose from, leading to something called paralysis by analysis. And therefore, they just tend to stick their head in the sand and pick the default option. And if you're finding value in this video, please hit the like button and subscribe to the channel. It does take us about 10 or 12 hours to get these videos created and published. So let's say a big thank you to Victoria for all your hard work. Now, we can't talk about workplace pensions without mentioning Nest. Now, Nest was introduced as part of the Pensions Act in 2008, with a scheme opening to new members on the 1st of October 2012. Now, it's designed to be low cost and easy to access, providing an option for employers who might not have had the resources to open up their own pension schemes or would have been accepted by some of the bigger pension providers. Now, Nest does have a contribution fee of 1.8%, which other pension providers do not have. And that's in place to repay the government loan which was used to set up Nest originally. Now, Nest is a not-for-profit provider, so that means that this contribution charge is likely to be reduced or even removed in the future, but when is anyone's guess. Now, there's also an investment charge of 0.3%. Now, as all default funds are capped at 0.75%, this offers relatively good value. Now, Nest has currently got over 10 million members and has over 23 billion invested in their funds. Unlike many workplace pension providers, your contributions in Nest are made relief at source. So any contributions are made after the deduction of income tax, and then tax relief is added back into the scheme after the contribution's been made. Now, this has been done to help those on low incomes who may not have qualified for tax relief, but they are able to claim tax relief under the Nest system. Now, Nest has a limited range of 6 funds to choose from, including their flagship default fund, the Retirement Date Fund, which is set to your state pension age, as well as offering 5 other risk-rated funds. So, for example, if you're due to retire in 2055, you will be invested in the Retirement Date 2055 fund. If you're due to retire in 2048, you would join the Retirement Date 2048 fund, and so on. You will generally start in the foundation phase, and that lasts approximately 5 years. And the intention of that is to outperform inflation after fees and charges. This is also to promote confidence in saving as well as investing, and to create good habits and not be emotionally scarred by the impact of volatile markets. Now, for many younger members of the scheme who may be looking to take on a higher level of risk because they've got a longer time horizon, Nest do have a Sharia fund which is 100% invested in equities. Now I'm going to show the 5-year performance graph on charts where it compares the performance against the relative benchmark, and all this is done with our friends at TrustNet. I'm going to leave their description in the link below as well. So as you can clearly see, we've got two lines on the chart. We've got a blue line and we've got a red line. The red line is the global equities benchmark over the last 5 years, and the blue line is the Nest Sharia fund, which is 100% invested in equities. And as you can clearly see, the Sharia fund has clearly outperformed the benchmark on a very consistent basis. And if you look at the table below, you can actually see that over 1 year, the Nest fund has performed at 30.5% against the benchmark at 16.4%. But if you look at the 3 years and the 5-year performance, it has consistently outperformed the benchmark over all time frames. And this information is accurate as at the 3rd of May 2024. Now, the top 10 holdings of the fund as at the 8th of May 2024 are Microsoft, Apple, Alphabet, Amazon, Nvidia, Tesla, Meta, ExxonMobil, Eli Lilly, and the famous Johnson & Johnson. Now, this level of risk and exposure to technology stocks won't be suitable for everyone, so please make sure you pick your funds carefully. Now, if you'd like me to record a video about how you can go about selecting funds for your workplace pension, then please drop me a line in the comments section below. Now, as we've discussed in previous videos, not all pensions are created equal, and some are going to be more flexible than others, especially when it comes to offering the full range of withdrawal options so you can create the most suitable strategy for your circumstances. For example, Nest does not offer either Flexi Access Drawdown or the ability to buy an annuity either. So you may want to consider looking to transfer to an alternative provider or even consolidate all your pensions in one place for greater control and for greater flexibility. So I'm going to link our pension consolidation video as well in the description below. Now, in the financial year 2022-2023, approximately 740,000 pension plans were accessed for the first time, according to figures published by the Financial Conduct Authority. And in 2022, approximately 137,000 pension pots were encashed in full that were under £10,000, and these are affectionately known as small pots. I would also like to thank at this point Terry for getting in contact with us to share his story about how he accessed his deferred pension schemes when he was preparing for his retirement. Now, small pots may seem very similar to flexibly accessing your pension, as both will give you 25% tax-free cash and the rest will be taxable. But there are a few key differences that could be beneficial for you, and they are that small pots do not trigger the money purchase annual allowance, whereas flexibly accessing your pension of the same amount does trigger the money purchase annual allowance. And that's going to reduce the level of funding for your future contributions to just £10,000 a year. So remember your personal allowance of £12,570 in the current tax year. This means you're going to be able to withdraw this amount every tax year and not pay any income tax or national insurance on that amount. You're also going to be entitled to a further £4,190 in tax-free cash too, making the total income withdrawal for the year of £16,760. But you may also want to consider looking at partial transfers away from your scheme as well. Now, this is going to allow you to transfer part of your workplace pension to another more suitable provider, so long as you leave a minimum balance in your workplace pension, and you'll still be able to make and receive pension contributions. But you need to check with your pension provider if this is possible. So in conclusion, we've looked at the ugly truth that 95% of people decide not to take control of their pension by doing nothing at all and just investing in the default fund. This is likely to be a lifestyle fund which automatically lowers the risk the closer you are to some arbitrary retirement age, which could leave you in low risk funds several years before you're due to retire. We've also looked at the ugly truth that we are not contributing enough. As a comparison, the Australian superannuation scheme has a compulsory contribution level of 11%, and that's increasing to 12% in 2025. How would you feel about a compulsory increase in your pension contributions to 10%? Let me know in the comments below. And we've also discussed how important it is to ensure that you've got full control of any income withdrawals in retirement. So clearly, workplace pensions have been a huge success, but there is still a lot of work to be done. And that starts with becoming more engaged in your pension and understanding that by selecting the right fund, the right risk level, the correct time horizon, your withdrawal strategy, you can significantly improve your retirement plans. So if you found value in today's video, please give it a thumbs up, hit the like button as well as a notification bell, and subscribe to the channel so we can get this financial wisdom as far and as wide as possible. And finally, this is your channel and your voice. So I thank you to all of you who've left messages and comments of support. I do read them all and I answer as many as I can. So if you've had a positive experience or even a negative experience with your workplace pension, please let me know in the comments below. We can share your story and we can all learn together. Thank you for watching to the very end, and please join me next week when we're going to be discussing pension investment strategies to help mitigate investment risk. See you all again next week, and thank you so much.